In just a few hours, the crypto market witnessed a bloodbath of epic proportions. It was the single largest liquidation event in the history of this market. Over $19 billion, let me say that again, $19 billion in leverage positions were wiped out in a brutal cascading flash crash. Well over 1.6 million traders saw their accounts evaporate in the blink of an eye. The price of Bitcoin plunged more than 14%, and altcoins were utterly shellacked. Some of the more speculative tokens dropped 50%, 70%, or in some cases even 80% in a matter of minutes. It was pure, unadulterated panic. The charts didn't just dip, they looked like a trapdoor opened straight to the center of the earth. But what if I told you this massive historic purge of leverage is not the end, but the beginning? What if this was the violent, painful, but absolutely necessary final act before Bitcoin goes truly parabolic? Today, we're breaking down exactly what happened during this record breaking shakeout. We'll look at the mechanics of how over $19 billion was erased from the market, who got hit the hardest, and why this brutal cleansing of speculative excess might just be the most bullish signal we've seen all year. I'm going to show you the on chain data and the historical cycle evidence that suggests the weak hands have been flushed and the market is now primed for a sustainable move to new all time highs. You're not going to want to miss this. So, what on earth just happened? To get the sheer scale of this, you have to understand the mood in the market leading up to it. It was euphoric. Just days prior, Bitcoin had been pushing towards new all time highs, with some reports showing it had been trading around $122,000. The fear and greed index was pegged in extreme greed. Crypto Twitter was nothing but rocket ship emojis and wild predictions. And then the floor fell out. It all started with a spark of geopolitical tension. Reports that the US was planning to impose an additional 100% tariff on China sent a shockwave of fear through all risk assets, not just crypto. But in the highly leveraged 24/7 world of digital assets, that spark ignited a powder keg. What started as a small dip quickly turned into an all-out liquidation cascade. Bitcoin's price plunged violently, slicing through support levels and at one point dropping to around $104,782 before finding some footing. But Bitcoin's drop was only part of the story. The real carnage was in the altcoin market. Ethereum lost over 11-12%, and Solana sank as much as 40% at one point. Meanwhile, some of the smaller, more speculative meme coins cratered by a staggering 50-70% or more. It was a complete and total reset for the most overheated parts of the market. Now, you're probably hearing these numbers and wondering, how is it even possible for $19 billion to get wiped out so fast? The answer is one word: leverage. Leverage is a double edged sword. It's a tool that lets traders borrow money to amplify their bets. With 10x leverage, you can put down just $10,000 of your own money to control a $100,000 position. If Bitcoin goes up 10%, you don't just make 10% on your 10 grand. You make 10% on the full $100,000, doubling your money. It's the siren song of crypto, promising life-changing returns. But the danger is just as amplified. If Bitcoin's price drops just 10% against that same 10x long position, your initial $10,000 in collateral is completely wiped out. The exchange then automatically and forcefully closes your position to get its loan back. That's a liquidation. What we saw wasn't just a few liquidations, it was a liquidation cascade, a domino effect of historic proportions. It starts when an initial price drop, maybe from that macro news, triggers the first wave of forced liquidations. These liquidations are just market sell orders, which push the price down even further. This new lower price then triggers the next wave of liquidations from traders whose positions were just a little bit safer. This adds even more selling pressure, pushing the price down again, and the cycle feeds on itself. It's like a snowball rolling downhill, getting bigger and faster. Market makers, the folks who provide liquidity, pulled their buy orders to avoid getting run over, which meant the market's ability to absorb all the selling just vanished. This creates air pockets in the order books, and the price just falls right through them. To make matters worse, several major exchanges even had glitches and outages from the sheer volume, preventing traders from adding collateral to save their positions. According to data from CoinGlass, an estimated 87% of the positions liquidated were longs, people betting the price would go up. This tells the whole story. The market was absurdly one-sided. Everyone was piling on more and more leverage in a fit of greed and FOMO. They were late to the party, and when the macro news hit, the rug got pulled. This wasn't a crash driven by fundamentals. It was a structural break caused by reckless gambling. It was a pure leverage flush. And while analysts point out that the actual capital lost by traders was a fraction of the $19 billion headline number, maybe closer to $1 to $3 billion in margin, the fact is that over $19 billion in synthetic exposure was violently torn out of the market. By all accounts, it was the largest deleveraging event in crypto history. I know for many of you watching, this was incredibly painful. Seeing your portfolio drop 20, 30, or even 50% in a day is a gut-wrenching feeling. Many people got wiped out, over 1.6 million traders, according to reports. It's important to acknowledge that, but it's just as important to understand what this means for the market structure. Because events like this, as brutal as they are often a necessary and ultimately healthy mechanism. Think of it like a forest fire. It's destructive and terrifying, but it clears out all the dead wood, allowing for new, healthier growth. This $19 billion liquidation was a market wildfire. It incinerated the weak hands, the over-leveraged speculative traders who were just chasing the pump without any real conviction. These are the traders who provide the fuel for major corrections. By flushing them out all at once, the market has removed a huge source of future selling pressure. This is what people mean by a healthy reset. The speculative froth is gone. Funding rates, which were sky high as longs were paying shorts to keep their bets open, have now crashed back to neutral or even negative. This means the reckless greed has been replaced by a healthy dose of fear, which is exactly the kind of environment where sustainable rallies are born. Let's look at the on-chain evidence. Reports suggest that while this derivatives-led cascade was happening, long-term holders barely flinched. There was no mass panic selling of actual Bitcoin on the spot market from seasoned investors. The supply held by long-term wallets remained steady. This shows that the conviction of the strong hands is unshaken. The selling was almost entirely contained in the speculative derivatives market. It was a washout of gamblers, not an exodus of believers. That difference is everything. A market that collapses because long-term holders are losing faith is a true bear market. A market that flash crashes to wipe out leverage before continuing its uptrend is a bull market doing what it does best. We've seen this exact dynamic play out multiple times in previous cycles. Sharp, sudden drops that shake out the tourists are often the final test before the real takeoff. Plus, this event creates an incredible opportunity. While retail traders were getting liquidated, you can bet that large funds and patient investors were seeing this as a massive discount. They see a market that has just deleveraged itself, removing a huge amount of risk, and they see a chance to buy assets at a cheaper price. The smart money loves to buy this kind of fear. The crash also showed how much the market has grown. The liquidations happened everywhere, from giants like Binance to decentralized platforms. This shows how deeply embedded leverage is in crypto, but it also shows that the system as a whole held up. There were no major exchange insolvencies or fund blowups reported in the aftermath, which is a sign of a maturing market that can withstand this kind of shock. So, while the headlines are screaming about billions being wrecked, the underlying story is one of purification. The market has just gone through a painful but vital cleansing. The speculative excess has been purged, the foundation has been reset, and the path forward is now significantly clearer. And before we get into the bull case and why history suggests we could be on the verge of something truly explosive, I want to ask you a quick favor. If you're getting any value out of this breakdown, if it's helping you make sense of the chaos, please take a second to hit that like button and subscribe to the channel. It's free, and it tells the algorithm that more people who are probably feeling pretty scared right now need to see this video. My goal is to cut through the noise with data-driven analysis. By subscribing, you make sure you won't miss the critical updates to come. Thanks for that. Now let's get into the good stuff. This is where it all comes together. A historic deleveraging event just happened. The market is cleansed. But why is this moment so important? It's because this shakeout aligns perfectly with two of the most powerful bullish forces in Bitcoin's history: the 4-year halving cycle and the new era of institutional adoption through spot ETFs. Let's start with the 4-year cycle. Bitcoin's price has always moved in predictable 4-year waves centered around its halving events. The halving is when the reward for mining new Bitcoin gets cut in half, slashing the rate of new supply. This supply shock has historically kicked off massive bull runs, leading to the 2017 peak and the 2021 peak. The last halving was in April 2024. And if you look at history, the most explosive parabolic phase of the bull market doesn't happen right away. It typically kicks off around 12 to 18 months after the halving. Well, here we are in October 2025, exactly 18 months post halving. We are right in the sweet spot where previous cycles began their most aggressive climb. These deep, painful corrections are a feature of this phase, not a bug. They shake out as many people as possible before the real move. If history is any guide, this massive liquidation isn't the end. It could very well be the final boarding call. But I know what you're thinking. The 4 year cycle is broken. This time is different. And you're half right. This time is different, but it's different in a way that could make this cycle even more powerful. The reason? The spot Bitcoin ETFs. The launch of spot Bitcoin ETFs in the US in 2024 was a seismic shift. For the first time, huge institutional players, pension funds, asset managers, corporations had a regulated, secure, and easy way to buy Bitcoin. This isn't a dream of institutional adoption anymore. It's happening. We've seen tens of billions of dollars flow into these products, creating a powerful and constant source of demand for actual physical Bitcoin. This creates a market dynamic we have never seen before. Past cycles were driven mainly by retail hype and a derivatives market that was still finding its feet. That's why we saw those dramatic 80-90% bear market crashes. Now, we have a bedrock of institutional, long-term capital holding spot Bitcoin. These aren't gamblers using 100x leverage. This is sticky capital that buys and holds, fundamentally changing the supply and demand game. Now, combine those two forces. You have the historical timing of the post-halving cycle screaming that we're entering the parabolic phase, and at the same time, you have the new reality of ETFs creating constant buy pressure and a higher floor for the price. This is the core of the bull case. The recent $19 billion crash was the market violently purging the last remnants of the old retail-driven speculative casino. It was a battle between the old crypto and the new crypto. The Deegan gamblers got wrecked, while the institutional spot holders likely saw the dip as a prime opportunity to buy more. What we are left with is a market that is structurally healthier and stronger than ever before. The weak hands are gone. The reckless leverage is gone. But the institutional demand remains. The post-halving supply shock remains. This is the perfect recipe for a powerful and, more importantly, a sustainable rally. The launchpad has just been cleared of all debris. So what should we watch for now? First, we need to see Bitcoin reclaim and hold the price levels from before the crash. Getting back above $120,000 and turning that into solid support would be a huge sign that the shakeout is over. Second, watch the derivatives market. We don't want to see open interest and funding rates immediately spike back to euphoric levels. A slow, steady, healthy rebuild of leverage would be ideal. Finally, keep an eye on those ETF flows. If we see net positive inflows return day after day, that's our confirmation that the institutional bedrock of this new market is still solid as a rock. So let's bring it all home. The last few days have been a whirlwind of fear, panic, and destruction. A record-shattering $19 billion in leveraged positions were annihilated, marking the largest liquidation event in crypto history. Well over 1 million traders were wrecked in a violent flash crash that punished greed. But this wasn't a fundamental breakdown. It was a structural cleansing, a necessary, brutal purge of speculation that has left the market in a much healthier place. The weak hands have been flushed out and the reckless gambling has been reset. What's left is a market standing on a much firmer foundation, a foundation built on the conviction of long-term holders and the unprecedented demand from institutional capital through spot Bitcoin ETFs. When you combine this newly cleansed market with the historical timing of Bitcoin's 4 year cycle, which tells us we're in the sweet spot for a parabolic move, the picture becomes incredibly clear. This wasn't the end of the bull market. This was the violent, chaotic event that likely signals the real beginning of the next major leg up. It was the final brutal shakeout. Now, I want to hear from you. What do you think? Were you affected by this crash? Do you believe this was the final shakeout before new all-time highs, or do you see more pain ahead? Drop your thoughts in the comments below. I read every single one. And if you haven't already, make sure you're subscribed with that notification bell on. In a market this fast moving, you can't afford to miss what comes next. The coming weeks and months could be some of the most important in Bitcoin's history, and we'll be here to guide you through it every step of the way. Stay safe, stay informed, and stay strong. I'll see you in the next video.